silver is way down. I mean, it's still $76. It's 50% above the double top from the all-time record high. So we still have a breakout in silver. Yes, gold's pulled back from over 5,500. It's now about 4,600. But that was a record high a few weeks ago. I think the Trump administration was behind it. I think a lot of his friends made a lot of money off of it, but I think it was a coordinated attempt to basically put out the fire from gold and silver, because I think gold and silver were basically warning that a dollar crisis was coming and a sovereign debt crisis. It was a real vote of no confidence in the administration, in the Fed, and I think they had to do something about that.
Silver may be way down, but at $76, it's still trading 50% above its former all-time double top, confirming a powerful long-term breakout. Gold's pullback from $5,500 to around $4,600 hasn't changed the bigger picture either. Those highs were reached only weeks ago and signaled deep systemic stress. As Peter Schiff has repeatedly argued, rising gold and silver prices reflect a vote of no confidence in the U.S. dollar, the Federal Reserve, and exploding sovereign debt. The sharp correction looks less like a free market move and more like a coordinated effort to cool warning signals of an emerging dollar crisis. Now, we present the clips from Peter Schiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold was down $500 on Friday, the last day of the month. It was still its best January ever, despite the decline. So, keep it in perspective. But I also don't think the sell-off was a natural event. I think it was orchestrated. I think the Trump administration was behind it. I think a lot of his friends made a lot of money off of it. But I think it was a coordinated attempt to basically, put out the fire from gold and silver, because I think gold and silver were basically warning that a dollar crisis was coming and a sovereign debt crisis. It was a real vote of no confidence in the administration, in the Fed, and I think they had to do something about that. So I think they coordinated the raid with the early release of Trump's Fed pick with false talking points to disseminate to the media that somehow this was some huge surprise and that Trump had decided to appoint a inflation hawk who will be much more hawkish than Powell and far less likely to cut rates. In fact, likely to start raising rates almost immediately, and less likely to use quantitative easing, more likely to resume quantitative tightening. That is the story that is being sold. And I don't buy it. I mean, I just think that's complete BS. But I think Trump was confronted with a situation that he needed to diffuse. The world was questioning Fed independence. They expected the next Fed chair to be a puppet of the administration. And it was based on that preparation. One of the reasons that you saw such weakness. Dollar hit 4-year lows, all-time record low against the Swiss franc, record highs in gold and silver. So they had to do something to push back against that narrative. And this is what they coordinated. And but I don't think that's true. I don't expect an inflation fighter. I expect a puppet. I don't think that Trump would have given Walsh the job if he really expected him, in his mind, to be worse than Powell, right? Because the reason he doesn't like Powell is because he hasn't cut rates enough. This guy, may even raise rates the way he's being portrayed. And so I don't buy that. And maybe what they try to do is nominate somebody who looks like a independent choice, who's not going to just do what Trump wants, but who is a real inflation hawk. Then when he goes and cuts rates anyway and does exactly what Trump wants, they'll be able to pretend that this is independent. They'll say, look, I appointed this hawk. If he's cutting rates, it must be economically justified. I mean, there's no political pressure here, right? I didn't appoint one of my guys. I appointed somebody who is, a hard money guy. And so I think that's part of the plan, right? To try to make it look like he's exercising his own judgment instead of just doing what Trump wants. Mm-hmm. So, but at the end of the day, I think the momentum out of the dollar into gold and the silver is going to continue. It may be slowed down. In fact, it was slowed down by this, but it's not going to be stopped. The only question is, how long will people be afraid to buy gold and silver because they're worried about this happening again? But it also is possible that now that we've got this big decline out of the way, people may feel more comfortable buying, thinking that, okay, it's already happened. Now I can step in. Obviously, buying silver at 76 is a lot more appealing than buying it at 126 or 121 where it got to. Mm-hmm. And, buying gold at 4,600 is better than 5,600. And Bitcoin was already selling off. The whole time gold was going up, Bitcoin was going down. Mm-hmm. And then, a lot of people expected that the money would rotate from gold and silver to Bitcoin, especially when we had that big drop in gold and silver on the Thursday, Friday. People expected, okay, the money's going to come into Bitcoin. Instead, Bitcoin had a big drop over the weekend. So not only did it not catch a bid from money leaving gold and silver, it got tanked too. And so, I think the Bitcoin trade is likely over. I've always thought it was a bubble. The bubble obviously got much bigger than I had expected when I first recognized that it was a bubble. But the air is coming out. Most people don't recognize that. Mm-hmm. And, I think that the main reason that the bubble got so big was gold went sideways for 12 years. After it had moved up from under 300 to almost 2,000, it, consolidated. And that allowed the Bitcoin community to kind of get the gold community to move into Bitcoin as digital gold, because Bitcoin was going up and gold was going sideways. And so everybody in Bitcoin was making a bunch of money and people weren't making money in gold. But now that gold is rising, it's hard to convince people that they need some alternative, that Bitcoin is better, because even though Bitcoin has delivered great returns, if you bought it 10, 15 years ago, it hasn't delivered good returns if you bought it more recently. I mean, the best example is Michael Saylor himself, who is the biggest Bitcoin buyer. He's been buying it for over 50 years. He spent close to $55 billion buying Bitcoin. And his average price on all that Bitcoin is just over 76,000. And right now it's 79,000. Right. So he barely has a gain. He would have been better off just, buying T-bills. He'd have more money. Now, the stock did better because he bought Bitcoin, because the fact that he was buying all this Bitcoin made people want to buy the stock. But the Bitcoin itself has been a lousy investment on its own, which should prove that all the hype was BS and the stock should come crashing down, because there is no actual benefit to MicroStrategy shareholders from owning all this Bitcoin. And the other problem is, of course, his meager gain is only on paper. If he actually tried to realize the gain by selling the Bitcoin, the price would collapse and he'd have huge losses. So he's in a very difficult position where he has a highly concentrated position that he can't sell. And I think that's why he keeps buying more, because it's his buying that is preventing an even bigger drop.
Gold's sharp $500 drop at month end didn't stop it from posting its strongest January ever, reinforcing the idea that the broader trend remains intact. Critics argue the sell-off in gold and silver was not natural, but a coordinated effort to cool markets that were signaling a dollar and sovereign debt crisis. The narrative of a surprise inflation hawk, Fed nominee, helped reverse record highs in precious metals and pressure the dollar rebound. Meanwhile, Bitcoin failed to attract rotating capital, sliding alongside metals and exposing ongoing bubble concerns. Despite short-term volatility, momentum continues to favor hard assets over fiat confidence. Let's get back to the interview.
When Greenspan was Fed chair, he specifically said that he followed gold as his main indicator, and it was a market mechanism to let him know if the decisions they were making were correct. So if the gold price was moving higher above 400, that told Greenspan that we're too loose and we need to tighten up. If gold went below 300, that would be the market saying, you're too tight. You need to ease, right? And he said that this, in a way, was a de facto gold standard, because gold was the barometer that he was using to guide him in his decisions. Now, Powell just said the other way, the Fed doesn't care about gold. Couldn't care less what happens to it. It's meaningless. Mm-hmm. And so the point I made on X is, well, who's right? Because they both had the job of Fed chair. So was Greenspan completely wrong, or is Powell completely wrong? And, I think Greenspan was correct. And the fact that gold was under 400 when Greenspan made that statement, and it's well over 4,000 now, over a 10x increase, that would suggest that interest rates have been too low, that the Fed has been too easy the entire time, according to Greenspan. And I agree. The gold price is telling you that. The Fed should be reacting to it. They should be tightening, but they won't do it because they know that, our over-leveraged economy can't handle it. When Volcker, raised short-term rates to 20%, it wasn't that he did it because he thought that would be good, that everybody would like that. He knew that it was bitter medicine that needed to be swallowed. And we had the worst recession since the Great Depression as a result of those high interest rates. But I think the problem now is the Fed realizes that if we swallow that medicine now, it'll kill us. We'll die from the medicine. So we may as well die from the disease because that's going to be later. Right. And so I think that's what's going on. The reason he's so dismissive of the warning that's being sent by gold and silver is because he says, look, we're not seeing it in the bond market, right? We're not seeing it in inflation expectations that would manifest themselves in higher yield. And he's missing the point that yields are higher than they otherwise would have been absent these fears building. But I think Powell is wrong to assume that because we're not seeing a wholesale run on the bond market, that that's not around the corner, that the gold market and now the silver market are just more sensitive to that loss of confidence. But the next domino that's going to fall is going to be the bond market and the U.S. dollar relative to fiat currencies, not just relative to gold. Mm-hmm. But the problem is you can't wait for that. I mean, if you wait for it to get that bad, again, what are you going to do about it? Right? If you don't heed the warning that gold is sending and you just continue, going over, towards the edge of a cliff, you're going to go over the cliff. And by then it's too late to say, yeah, well, I guess there was a warning there. It's like, all right, well, now what are you going to do? Because it's a full-blown dollar crisis. It's a full-blown sovereign debt crisis. But that's where we're heading. And I think some people in the government might know that. And I think their primary goal is just to delay the crisis. They don't want to stop it. They don't even want to lessen it. They just want to delay it. That's their primary goal. Don't let it happen on our watch. First, the goal is to get through the midterm, and then just get through the election, right? The dollar dropped to a 4-year low before, Trump announced Walsh and everybody pretended he was a hawk. The dollar hit an all-time record low against the Swiss franc. So it's never been that low. Swiss franc is another, canary in the coal mine. Long-term interest rates, the Fed has already lost control. Long-term interest rates are higher now than they were before the Fed started cutting rates. Even if you go back to the first rate cut, they've cut rates 6 times and long-term rates have gone up. That's not what they wanted. So the bond market is not cooperating. So that's already a sign that there's a problem because the market is recognizing that, we're not good for the money, that we're not going to be able to repay our debt without massive inflation, which doesn't count as repayment. It's basically a surreptitious way of defaulting. And if you're a creditor of ours, you don't want an inflationary default. You want to just get out, right? You want to do something else. So you're going to buy gold instead of treasuries. And that's what they've been doing.
Former Fed Chair Alan Greenspan openly treated gold as a policy barometer, using its price to judge whether monetary policy was too loose or too tight, a de facto gold standard. Today, Jerome Powell dismisses gold entirely, despite prices rising more than 10 since Greenspan's era, signaling prolonged monetary excess. Critics argue this surge reflects deepening loss of confidence in the U.S. dollar, treasuries, and sovereign debt sustainability. While officials point to bond markets as calm, long-term yields rising alongside rate cuts suggest otherwise. Gold and silver are flashing early warnings of a looming dollar and debt crisis, one policymakers appear intent on delaying, not fixing. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.